If you open your brokerage app right now, you will find an amount of advertising and bombarding messages that are trying to get you into the next technology or the hottest commodity. What you have to do is fending off the noise, understanding how you can truly stay the course, diversified, and not risk a fine in order to sustain your wealth for the future. We need to assess what are the key red flags and instead the reassuring signals before buying an ETF, especially for European tax complex systems. Let's get to it. Hello fellow wealth seekers, welcome back to the channel. We get right to this important list starting at the top. We are looking at the domicile of our funds. In Europe, due to PRIIP regulation, you cannot buy US domiciled funds right away. You must do so through a legal entity in Europe. And even if you could, you shouldn't, because there are tax advantage regulations that make it so much better to just buy one domiciled in Ireland or Luxembourg. Ireland itself has a reduction on the dividend withholding tax from 30% to 15%. And that's why a great broker such as IBKR is domiciled there. Make sure that you buy tickers with the UCITS nomenclature. Check number 2. How do you want the structure of your portfolio to look like? Do you want to get dividends right away? Or do you want those to sit, reinvest, and accumulate without even seeing the shadow of a tax on that? The moment you sell, a selling capital gain tax is triggered, so you're automatically giving up 20 to 30% depending on your country. If instead you look for ACC or accumulating nomenclature in your ETF, that basically means you are reinvesting everything, bypassing completely the tax discussion all the way until the moment of sale. Yes, there are exceptions such as the prepayment tax in Germany or the Netherlands, but those are, again, exception, local based, and there's anyway an exemption to that in terms of amount you can simply get back each year. So let's focus on accumulating instead of having the manual hustle of calculating dividends each year. Number 3, the total fees. Extraction rate is an important KPI to look at. Total expense ratio, TER, shows how much you're giving up every single year in fees. This is acceptable between 0.07% and 0.25%. That is quite common. Most globally diversified ETFs won't be charged for more than that across the renowned brokers. But look also at the tracking difference. This is the amount that you get charged on top for intra-broker movements. It's quite common. They might resell the index to make a little margin on that and moving them across the economy. But you cannot be charged for that. A tracking difference close to 0% shows high efficiency. Next, paramount is safety. An ETF that is not highly liquid might force to close down and sell, triggering a tax event for you. We don't want that. For that, we use the AUM KPI, asset under management. Core ETFs that have below 500 millions in here don't show a lot of liquidity and spread in the market. That means that are acting as a potential risk for us. VWC has billions in AUM. Always look at this tiny metric to just make sure that you are buying something that is quite common in the market. Next, extremely essential, physical versus synthetic. Only buy synthetic when you are forced by local regulations, such as the PE in France, which only allows local domiciled ETFs. Hence, you need to convert into basically packages that go through investment banks in order to buy international funds. If you go for physical instead, your broker directly owning Apple, Microsoft and such, you cut through the middleman and avoid getting into an unpleasant situation such as Lehman Brothers in 2008, with many replicated funds packaged by several banks, triggering a chain effect. Check number 6, overlaps. You audit all your overlapping ETFs. That is a very common mistake. 4 in 10 investors fall for the over-diversification. They simply buy S&P 500, MSCI World, Nasdaq 100, and end up with the same stock 3 times. MSCI World or Vanguard already cover 70% of US stocks. Do not also invest in the S&P on your own. It is essential to avoid paying more ETFs for the same thing, so the fees are compounding for no reason. Simplicity is king. Last but not least, broker compatibility. Make sure that your broker is not only locally allowed to operate with a simple saving plan, automated, but also that they are not encountering any fees in exchange of currency, because your broker must be allowed to operate in the country you're in. The primary example is IBKR, highly favored by everybody, but not efficient in a country such as the Netherlands, but instead the King of Ireland. So there you go. You want a new CITS fund domiciled in Ireland that has potential to accumulate and not distribute the dividends only, that costs less than 0.25% in fees, holds over 500 million in assets, uses physical replication, and trades in your local currency with 0 brokerage fees. Simple, automated, safe. Do not guess. Audit your plan clinically. I hope this was helpful. Let me know if any question. Show some love, retention, and engagement in the comments. Leave a like and subscribe. That tremendously helps the channel. Thank you so much. I'll see you in the next session. European Wealth Lab out.